Yeah. Hello, everyone. Welcome to today's session on insolvency and international capital market. My name is Sanjay. I'm a chartered accountant. I work closely with the insolvency cases, financial restructuring. Today, I'm gonna take you through how insolvency affects the international capital markets. What are the nuances in it? So, let me begin with a simple but powerful question. What does a mutual fund manager in Mumbai, a bond investor in London, and a pension fund in Singapore all have in common? So, the answer is they're all watching what happens when an Indian company defaults. So, insolvency is no longer just a courtroom matter. It's a market event. And in today's capital markets, news of a default doesn't just stay in a legal file. It moves yields, triggers redemptions, and shakes investor confidence. When a company enters insolvency, every class of investor begins re-evaluating their risk. The equity guys worry about dilution or suspension. Bondholders fear haircuts. Lenders become cautious. And mutual funds, well, they fear redemptions. Take the DHFL case. Once it went into IBC, mutual funds holding DHFL bonds saw outflows. It wasn't just about DHFL, it was about contagion, fear that other NBFCs might be next. So this is why insolvency resolution under the IBC is not just a legal process, it's a tool to preserve capital market confidence. So here's where it gets serious. A large default can trigger liquidity crunches across the system. Island FS is the best example. It was not a listed entity, but it had tentacles in mutual funds, banks, and pension funds. So when it defaulted, credit markets froze, yields shot up, risk appetite vanished, mutual funds had to restrict redemptions. So when we talk about insolvency in the capital market context, we are really talking about stability and trust. So the Insolvency and Bankruptcy Code gives a structured, time-bound mechanism for resolution. That predictability is critical for investors. It tells them even if there's a default, there's a fair process. So compare this with pre-IBC days where winding up petitions dragged on for years. Nobody wanted to touch distressed debt. Today, global investors are showing interest in distressed assets in India because IBC has made recovery feasible. Even bondholders who often didn't sit on COC are now lobbying for representation and fair treatment. So let me share something interesting. So in the SREI insolvency, bondholders raised concerns over COC formation and valuation. They made public disclosures, lobbied through trustees, and even approached NCLT for clarity. Why? Because they had real skin in the game. They weren't just investors, they were creditors. So I want you to think about this. Can we truly claim to protect investor interest if the insolvency process doesn't acknowledge the structure of modern capital markets? Should bondholders who fund infrastructure and housing companies have a more prominent role in COC? Should there be special regulations for financial instruments like NCDs during CARP? So look at this. Post DHFL's admission to IBC, yields on lower rated NCDs surged by over 200 basis points. That's not just fear, that's real money moving out of the system. So investor confidence, once shaken, takes years to rebuild. So insolvency today isn't just about a company, it's about the ripple effect. So every resolution sends a message to capital markets. Are we fair? Are we fast? Are we transparent? And that's why understanding this link between insolvency and capital markets is so crucial. Because when trust breaks down at one end, capital dries up at the other. So let's now move to next slides and where we discuss about who these investors really are and what kinds of instruments are most exposed to insolvency risks. So, when we talk about capital markets being affected by insolvency, it's important to understand exactly who these investors are because they're not one homogeneous group. They come in different shapes, sizes, and levels of sophistication, and their exposure to insolvency differs accordingly. So in this slide we'll explore who these investors are, how they participate in the capital markets, and how their interests and legal rights intersect with insolvency resolution processes like the IBC. So let's start with the largest players, institutional investors. These include mutual funds, insurance companies, pension funds, sovereign wealth funds, and foreign portfolio investors. So these entities manage huge pools of money on behalf of individuals. For example, a mutual fund might hold debentures issued by a real estate company. A pension fund might have invested in infrastructure bonds. A sovereign wealth fund might be strategic shareholder in a distressed corporate. So the key thing to remember is these investors usually don't deal in equity alone. Their exposure often lies in debt, instruments like non-convertible debentures, NCDs, secured bonds, or even structured products. When a company enters insolvency, they stand to lose not just returns, but trust, and that affects a long-term capital flow into the country. Next, let's talk about bondholders. Um, these are investors who have lent money to the company in return for fixed interest payments and a promise of repayment at maturity. Bondholders can be secured, where the bonds are backed by specific assets, example, land, machinery. Unsecured, where no collateral is pledged. So, in insolvency proceedings, secured bondholders have a better chance of recovery. But here's the twist: under the current IBC framework, bondholders are often treated like any other financial creditors, but they don't always sit on the COC, especially when represented through a debenture trustee. This leads to a disconnect. Decisions that directly affect bondholder recoveries, such as approval of resolution plans, may be taken without their direct participation. And this creates both legal and reputational risks. So, in many bond issuances, especially listed NCDs, investors don't hold the securities directly. Instead, they are represented by a debenture trustee, typically a bank or financial institution appointed to safeguard the interests of bondholders. Under SEBI regulations, debenture trustees are supposed to monitor covenants, track defaults, and act swiftly in case of non payment. But in practice, many trustees have been passive. In the DHFL case, bondholders complained that trustees didn't file claims in time, they didn't disclose plan details, and didn't challenge valuation assumptions. So, this undermines investor confidence and shows that debenture trustees must be more active participants in insolvency cases. Next, foreign investors often participate in Indian capital markets through the FPI route. So these FPIs may hold bonds, structured products, or equity stakes. When insolvency hits, they often face a dual challenge. One, legal unfamiliarity. They may not be aware of Indian insolvency timelines, claim processes, or voting mechanisms. Jurisdictional disconnect. In some cases, foreign bondholders have to work through a global custodians or treaty-based protections. So recognition of foreign claimants under IBC isn't automatic. In cross-border cases, like we discussed in the previous session, lack of formal recognition may lead to limited participation or delays. For India to truly attract global capital, the rights of the FPIs in insolvency must be clear and enforceable. Next up is PE, private equity and venture capital funds. So PE and VC funds usually invest in equity or convertible debt. Their exposure to insolvency is unique, not always as creditors, but often as promoters or board observers. If a company funded by a VC enters into insolvency, these funds may lose board rights, be classified as related parties and excluded from COC, face reputational damage or LP scrutiny. But there's also an opportunity. Some PE funds specialize in distressed investing, buying into companies under IBC to acquire them at a discount. These investors play a critical role in resolution, but they also demand transparency, fairness, and speed, all of which the IBC is still perfecting. Um, Let's not forget retail investors. Many individuals invest in listed NCDs, tax-free bonds, or even mutual funds exposed to corporate debt. When a company defaults, their losses may seem small in quantum, but they are devastating in impact. Retail investors are rarely represented in COC, have limited access to information, and often rely on intermediaries who may not act in time. So the DHFL case had thousands of small bondholders who struggled to understand the process or make their voices heard. For insolvency law to be truly inclusive, we must find ways to give retail investors visibility, even if not voting rights, in large corporate resolutions. So, to conclude this particular discussion, investors in capital markets are a diverse bunch. Some institutional giants with legal teams and strategy. Others are individuals with limited resources. Some are securitors. Others hold a hybrid or structured debt. And yet, when insolvency happens, they are often lumped together as financial creditors without nuance. Going forward, reforms must address their diversity. Maybe that means differentiated disclosure. Maybe that means rethinking who gets a seat at the COC table. Maybe that means empowering trustees with accountability. But one thing is clear, the capital market investor must no longer be treated as a silent spectator in insolvency. They are stakeholders and they must be heard. Let's move to the next slide. Okay, now that we have discussed the different types of investors affected by insolvency, let's take a closer look at the actual financial instruments they invest in. Because when a company enters insolvency, it's not just about who is investing, it's also about what they are investing in. These instruments are the very link between corporates and capital markets, and each comes with its own rights, risks, and complications in resolution. So let's focus on four broad categories: non-convertible debentures, external commercial borrowings, ECBs, real estate and infrastructure trusts, REITs and InvITs, and structured debt instruments. Let's start with the most common debt instrument in Indian capital markets, the NCD. These are fixed income instruments that cannot be converted into equity and are usually issued for medium to long term funding. Why are NCDs important in the context of insolvency? Because they are widely held by mutual funds, banks, insurance companies, and sometimes even retail investors. They may be secured or unsecured. They are governed by trustees and involved debenture trustees. So, when a company defaults on an NCD, bondholders may be classified as financial creditors under the IBC. But challenges remain: valuation disputes in resolution plans, lack of voting power if trustees don't participate actively, haircuts that may not reflect real risk reward expectation. In cases like DHFL and Reliance Capital, NCDs worth thousands of crores were on the books. So these instruments became central to the resolution process. Next, we have ECBs, external commercial borrowings, a popular route for Indian companies to raise foreign currency debt from international investors. So these borrowings come under RBA regulations and are subject to end use restrictions, maturity criteria, and hedging norms. ECBs are often raised by large corporates, infrastructure companies, and NBFCs. What makes ECBs tricky in insolvency? They're governed by international laws, not just Indian law. Um, the lenders are often foreign entities, investment banks, sovereign funds, or DFIs. In case of default, currency risk becomes real. The borrower may not only default on principal but also on forex hedging. For example, when Jet Airways defaulted, it had ECBs in its books. The foreign creditors faced challenges in filing claims, understanding their rights under Indian law, and coordinating with domestic lenders. So, this is where cross border coordination, recognition protocols, and clarity in claims becomes essential. Now let's talk about real estate investment trusts, REITs, and infrastructure investment trusts, InvITs. These are relatively new products in Indian capital market, but are gaining traction among institutional and retail investors alike. These trusts pool money from investors to invest in income generating assets like office buildings, REITs, or toll roads and power projects, InvITs. How do insolvency risks arise here? The sponsor entity of the trust may default or face CARP. Project level SPVs may face cash flow issues. Investors may face distribution disruptions if rental or user fees are delayed or defaulted. For example, if an InvIT managing toll roads doesn't receive payments from NHAI, or if traffic revenue collapses, its cash flow gets hit. If debt service falters, investors suffer. So the complexity here is structural because rates and invets involve multiple layers, contracts, and parties. Insolvency of one party can trigger defaults. Um, so that's with rates and invets. So next, structured debt instruments. So structured finance is where things get more exotic. So these include securitized debt instruments like PTCs, hybrid bonds, convertible preference shares, credit enhanced NCDs, subordinated debt, tier 2 capital. So these instruments are often held by sophisticated investors and used for risk transfer or capital optimization. But when insolvency hits, they pose huge challenges in terms of priority of payments, tranching of risk, treatment under resolution plans. So, for instance, a mutual fund holding subordinated NCDs may find itself last in line during liquidation, or an investor in a credit enhanced bond may find that the guarantor is also in insolvency. So Srey and Reliance Capital cases had several layers of such instruments, making resolution far more complex. So let's now look at some legal questions that arise. Should holders of secured NCDs be treated differently from banks? Can rate or InvIT investors claim under IBC if an SPV is admitted into CARP? How should structured finance products be valued during resolution? Can a foreign bondholder under ECB route trigger Section 7? So these are not just hypothetical questions, they are being litigated in real cases. That's why it's important for practitioners or market participants to understand the instruments involved, not just the law in isolation. So, to sum up, capital markets don't function on equity alone. Debt markets, with their diverse range of instruments, are now deeply linked with insolvency. Whether it's a retail investor holding NCDs, a foreign fund lending through ECBs, or an institutional investor in an InvIT, the instrument determines their rights, risks, and recovery in CARP. So, as we move forward, harmonizing the IBC with capital market instruments, especially through SEBI, RBI, and IBBA collaboration, is going to be essential. So, next, let's just move to the next slide. Okay. So now that we've covered who the investors are and what instruments they use, we must ask who regulates all of this. because without clear rules, investor protections, and enforcement, the capital market side of insolvency becomes a minefield. So in India, we don't have a single unified capital market insolvency regulator. Instead, several authorities share the responsibility. This creates both opportunities for collaboration and challenges due to fragmentation. So we'll look at the roles of SEBI, RBBI, IBBI, and credit rating agencies in managing the intersection of capital markets and insolvency resolution. Let's begin with SEBI, the Securities and Exchange Board of India. SEBI regulates all listed entities, mutual funds, REITs, InvITs, portfolio managers, and most importantly, debt issuances like NCDs. SEBI's responsibilities in insolvency related matters include ensuring listed companies provide timely disclosures during CRP, regulating debenture trustees and their obligations, monitoring related party transactions during resolution, protecting investor interest in mutual funds exposed to defaulted securities. In the DHFL case, SEBI worked closely with the administrator and the mutual fund industry to ensure transparent disclosures. Next is RBI. So RBI's role becomes critical when the distressed company is an NBFC or a bank or has taken external commercial borrowings. Here's where RBI steps in, regulating provisioning norms for banks exposed to insolvent entities, monitoring NBFCs and housing finance companies under resolution, supervising foreign borrowings under ECB guidelines, approving resolution plans for entities under financial sector regulation. So in ILFS, SREI, and DHFL, RBI's role was pivotal. So next up is IBBA, the Insolvency and Bankruptcy Board of India, is the regulator for insolvency professionals, IPs, information utilities, IUs, and registered valuers. It also frames regulations for CARP, liquidation, and voluntary liquidation. In the context of capital markets, IBBA handles admission of claims by bondholders and other capital market creditors, regulating disclosures by RPs and valuers in IM and RFRP, monitoring timelines for admission, plan noting, and compliance, conducting training and certifications for IPs involved in market facing cases. The last is the credit rating agencies. Although they are not regulators, CRAs, credit rating agencies, play a huge role in shaping investor perception before and during insolvency. So they provide early warning by downgrading issuers facing stress, issue default grades and stop coverage in many cases, influence bond pricing, mutual fund exposure and capital allocation. Having multiple regulators means diverse perspectives and domain expertise. So this is one of the challenge. If there are multiple regulators, we have diverse perspectives, and the domain expertise is different, and fragmentation in oversight happens, and unclear jurisdiction in crisis situations. For example, a defaulting InvIT may fall under a SEBI for trust regulation, IBBI for claims and resolution, RBI if loans are NBFC backed. So some progress has been made. For example, SEBI has updated disclosure norms for listed entities under CARP. RBI has allowed resolution under IBC for NBFCs above threshold. IBPA IBBA consults SEBI for updates to CRP regulations involving listed securities. So, in conclusion, the capital markets exposure to insolvency cannot be managed by one regulator alone. SEBI, RBI, IBBI, and others must align, coordinate, and co regulate to build investor trust and market resilience. So, let's go to the next slide. Okay. So, till now we discussed frameworks, instruments, and regulators, but theory comes alive through practice. So, and in the In the world of insolvency and capital markets, real cases drive reform. So they expose gaps, test regulatory coordination, and deeply influence investor psychology. So we'll look at three landmark cases: ILFS, DHFL, and Reliance Capital, and examine how they shaped the capital market narrative around insolvency in India. Let's start with ILFS. So, infrastructure leasing and financial services, ILFS, was once considered a rock solid financial institution with over 300 group entities and heavy infrastructure exposure. It had borrowings from mutual funds, banks, insurers, and even pension funds. So in 2018, the default of ILFS subsidiaries sent shockwaves across the financial system. What made it worse was lack of early warnings, complex group structures that hid real liabilities, delayed recognition of stress by rating agencies, weak corporate governance. So, what was the impact on capital markets? So, massive redemption pressures on debt mutual funds, liquidity tightening for NBFCs and HFCs, flight of capital from corporate bonds rated below AAA, questions over role of independent directors and auditors. So the government stepped in, replaced the board, and undertook a resolution plan outside India, outside IBC, sorry, using a special framework. This case highlighted the need for group insolvency frameworks, early warning systems, better alignment with between SEBI, RBI, and IBBA. To date, INFS remains a cautionary tale of institutional complacency and regulatory fragmentation. So next is our DHFL. Diwan Housing Finance Corporation Limited was another big name, an HFC with a strong market presence, but it defaulted in 2019 amid allegations of fraud, over leveraging, and promoter siphoning. So its case was the first time RBI referred a financial services entity for resolution under the IBC framework, a move that expanded IBC's applicability and opened new discussions around regulatory coordination. So, key developments are admission under IBC upon RBI referral, over 87,000 crore of claims, majority from bondholders and banks. First COC to include both banks and bondholders. Piramal Group's resolution plan was approved at a steep haircut. So what is the capital market implications? So bond mutual funds faced NAV write-downs. Debenture trustees were questioned for lack of action. Retail bondholders were confused about their rights. Secondary market trading of distressed bonds increased. So the DHFL resolution taught us that financial service entities can be resolved under IBC with RBI referral, that bondholder participation must be better institutionalized, that public communication and disclosure are essential during CARP. Okay, next up is Reliance Capital. Reliance Capital defaulted on bond repayments and loan servicing obligations. RBI superseded its board and referred it to NCLT under IBC in 2021. Key complexities: over 20 subsidiaries, including insurance and securities arms, multiple types of bondholders, secured, unsecured, listed, and unlisted, disputed valuations, and asset ring fencing claims, delays in COC formation and plan evaluation. So, capital market impact: investor uncertainty over rate like exposures and pledged assets. So rating agencies stopped coverage after downgrading to D. Trustees were hesitant to take active litigation steps. So what Reliance Capital exposed was weaknesses in handling multi-layered financial conglomerates, lack of guidance for valuation of complex asset pools, absence of centralized information utility for market-linked debt, how CARP delay erodes bondholder confidence and value. So, what's the common lesson among from all these three cases? Disclosures to capital markets need to be standardized across across all the insolvency stages. Debenture trustee accountability must be increased. Institutional coordination between RBI, SEBI, IBBI must become structural, not ad hoc. Legal clarity for retail bondholders and FPIs is still inadequate. Rating agency withdrawal norms during insolvency must be tightened. So these cases, INFS, DHFL, Reliance Capital, were not just legal or financial stories. They were systemic events that changed how regulators respond, how investors behave, and how legal frameworks evolve. They also taught us that capital market reforms cannot be separated from insolvency reform. So let's go to the next slide. Okay. So capital markets respond in real time. Even before a company is officially admitted into CARP, investors begin to react, pulling out money, downgrading expectations, or demanding higher yields. This is where credit ratings and yield movements become central to our discussion. So we'll examine how insolvency affects credit ratings and what happens to market yields, uh, both during the lead up to default and throughout the resolution process. So, understanding the credit ratings are independent opinions about the ability of an entity to meet its financial obligations. They range from AAA, which is strongest, to D, default. What's important is downgrades happen quickly once stress is suspected. Post default coverage may be withdrawn. So post default the coverage may be withdrawn, leaving investors in the dark. Ratings affect everything: bond pricing, mutual fund exposure caps, risk capital allocation. For example, DHFL went from AA plus to D in less than 6 months. So IRNFS group ratings were downgraded rapidly across 50 plus entities. So these rapid rating actions often preempt official insolvency filings. They act as leading indicators of stress or distress. So that when a company's creditworthiness is in doubt, its bonds start trading at a discount. This raises the effective yield or interest rate that new investors demand. Yields on corporate bonds are a direct signal of perceived risk, liquidity premium, and haircut expectations. After DHFL's default, its NCDs traded at a yields of 18 to 25%, up from 9 to 10%. For Reliance Capital, certain serials were trading at under 50% of face value, indicating deep distress pricing. Even good companies in the same sector feel the heat. Contagion spreads through yield repricing. So, one major consequence of rising yields and downgrades is a freeze in the secondary debt market. So, mutual funds face redemptions and are forced to sell bonds at steep discounts. NBFCs and real estate firms struggle to roll over commercial paper. Risk appetite disappears, even fundamentally strong borrowers suffer. This happened post LNFS, where the entire debt market practically shut down for mid-tier NBFCs. Even HDFC and Bajaj Finance saw temporary spikes in their bond yields. So rating agencies walk a tightrope. If they downgrade too soon, they're blamed for overreacting. If they act too late, they're accused of being asleep at the wheel. So post DHFL and INFS, SEBI tightened norms for rating agencies, mandatory review triggers for promoter pledges, auditor resignations, and delay in disclosures, more documentation and surveillance on complex structures. Still, questions persist. Should CRAs publish post default commentary? Should they be held accountable for abrupt rating suspensions? Investors need transparency, not just grades. So that's the underlying part. So in CARP, resolution applicants and COC members often use credit ratings as a proxy for risk assessment and recovery potential. Low rated or defaulted instruments receive steep haircuts. Valuation depends on market benchmarks and traded deals. For instance, in the DHFL resolution, certain bond series received under 40% recovery. Others fared better due to security cover. So credit ratings combined with market yields give professionals a sense of what the market expects in terms of loss given default (LGD). A large downgrade or insolvency admission sends signals far beyond the company involved. Investors reassess entire sectors like NBFCs or infra. Lenders become conservative in credit appraisal. Equity markets react to cross holdings and sponsor exposure. So, while insolvency is a legal process, its market impact spreads through asset repricing, sentiment shifts, and capital allocation decisions across the ecosystem. So, to wrap up, credit ratings and market yields react before insolvency proceedings begin. They are signals and sometimes warnings for investors. Regulators and resolution professionals must take these signals seriously. So, let's go to the next slide. Okay. So foreign investment is vital for India's growth. Our companies borrow from global banks, issue offshore bonds, and attract institutional money from sovereign funds and asset managers. But all this capital comes with one big assumption that if things go wrong, there will be legal clarity and recovery. Uh, let's explore what happens when cross-border investors face insolvency situations in India, the risks, gaps, and concerns around capital flows, treaty protection, and recognition. So let's define the players we are talking about. Foreign portfolio investors, FPIs holding rupee denominated NCDs, foreign banks lending under ECB frameworks, bondholders in offshore jurisdictions, example Singapore, London, Luxembourg, private equity and structured credit funds based in Mauritius, UAE, or Europe. So these investors contribute billions to Indian corporates. But when default happens, their biggest question is what protection do we have? So problem one is no treaty-based protection for insolvency. So India has dozens of bilateral investment treaties, BITs, but most of them don't cover debt claims or insolvency disputes. Many were terminated after the White Industries arbitration. So foreign investors are often advised that initiating investment arbitration for recovery of defaulted bonds is extremely difficult. So they must rely on domestic forums, primarily NCLT, which may not recognize their rights automatically unless their instruments are properly documented. Trustees act in time, they are not classified as related parties. So the absence of investment treaty fallback makes cross-border bond investing riskier. So problem two is procedural barriers in CRP participation. Even when FPIs want to participate in CARP, they face practical hurdles. Lack of awareness of timelines, public notices, and claim processes, communication gaps due to offshore custodians or nominee structures, ambiguity in Indian law about who can vote in the COC. So many foreign bondholders miss out on submitting claims within the deadline. Others face difficulty in having their claims verified by the RPs, especially when bonds are dematerialized, held through multiple custodians, or lacking Indian trustee representation. Problem three is enforcement risk and jurisdiction gaps. Suppose a foreign bondholder wins a decree in Singapore, can they enforce it in India if the company is under CRP? Not easily. The moratorium under Section 14 of IBC prohibits most enforcement actions. Foreign creditors must file claims and wait for distribution just like everyone else. But India doesn't yet have a working cross-border insolvency law. Sections 234 and 235 remain unnotified. So Indian courts don't formally recognize foreign insolvency proceedings either. So this creates a vacuum where foreign creditors neither have access abroad nor clarity at home. So that Jet Airways case is an example of how difficult this coordination can be. Uh, Dutch bankruptcy administrator wanted recognition in India, initially denied. NCLAT later allowed coordination through a cross-border protocol. This shows that Indian courts are willing to cooperate, but without a statutory framework, foreign creators still face unpredictability. So the IBBS draft Part Z based on ancestral model law aims to fix this, but it remains pending. So, in global capital markets, perception matters. The more uncertain a jurisdiction is around default recovery, the higher the yield investors will demand, or worse, they may not invest at all. Unclear rules leads to higher pricing of sovereign and corporate risk. Limited enforcement leads to preference for English law or Singaporean arbitration. No recognition of foreign claims leads to reduced participation in distressed debt market. If India wants to attract long-term capital, especially in infrastructure and real estate sectors, it must ensure that foreign investors feel legally protected when insolvency arises. So, what needs to change? Notify and operationalize cross-border provisions under IBC. Build institutional channels for foreign claim submission, example RBI or SEBI to issue guidelines or guides. Encourage debenture trustees to onboard foreign bondholders proactively. Clarify COC participation rights for FPIs. Sign more bids that include debt claims and insolvency mechanisms. Train insolvency professionals and adjudicating authorities to handle offshore participation better. So, to conclude, global investors don't just look at returns, they look at enforcement. Without clear insolvency rights, offshore capital will always price in additional risk. And when foreign capital dries up, the burden falls back on domestic banks and public funds. So, let's now discuss another reason why market investors struggle during insolvency, lack of timely and accurate information. Okay. So capital markets thrive on information. Every buy or sell decision is based on signals, balance sheets, cash flows, disclosures, ratings. But when insolvency hits, the first thing to disappear is information clarity. Let's explore how information asymmetry affects investor confidence during insolvency proceedings and why market discipline weakens when transparency fails. So, what do you mean by information asymmetry? In simple terms, information asymmetry occurs when one party has more or better information than others. In the context of insolvency, promoters may know more about asset quality than lenders. Resolution professionals may control access to financial data. Some COC members may have internal evaluations not shared with the public. For capital market investors, this means difficulty assessing true value of instruments, no visibility into asset monetization progress, uncertainty about realizable recovery. So, this results in distressed pricing, panic selling, or complete investor exit. So, despite IPC's structured framework, several disclosure gaps persist. No real time updates on admitted versus claimed amounts. Information memorandum often lacks granularity. Resolution plan terms may not be made public until approved. Investors have no access to data rooms unless part of COC or bidders. Delays in uploading key orders or claim forms on the IBBI or NCLT websites. Compare this with listed company norms under SEBI, LODR, insolvency. Insolvency feels like a blackout for investors. So, what is the impact on investor behavior amidst all of this? Without proper information, capital market participants tend to discount prices heavily, leading to false signals of value erosion. Avoid subscribing to new issuances due to fear of future default. Exit entire sectors due to one insolvency event. This is why after ILFS and DHFL, NBFCs faced bond market shutdowns. Even strong companies couldn't raise debt easily. So, what should what is the role of resolution professionals and data access here? So, resolution professionals play a central role in managing CRP data. They control the IM, RFRP, claim lists, forensic reports, but there's no obligation to share information beyond the COC. What if an NCD investor wants to understand valuation or a foreign bondholder wants to check if their trustee submitted claims? There is no standard protocol for public information flow during CRP, unlike the continuous disclosure obligations for listed companies under SEBI regulations. So, should we have some CRP specific disclosure norms? I think absolutely. A case can be made for CRP specific information templates, weekly updates on IBBA dashboard on claim verification status, public access to RFRP milestones and planned timelines, immediate uploads of NCLT orders affecting investor rights, mandatory summaries of resolution plan terms before final COC redacted as needed. We can do that. If such disclosures were mandated, investor panic would reduce and pricing would become more efficient. So, what? How does market discipline works, and what is the cost of this opacity and lack of transparency? So, opacity also undermines market discipline. When investors are kept in dark, pricing fails to reflect real risk. Promoters game the system through related party transactions. Um, they can do that through related party maneuvers. So poor resolution plans gets passed without challenge. This leads to a breakdown of accountability and eventually reputational loss for the entire IVC ecosystem. So imagine if all insolvency data, claims, plan summaries, timelines were integrated into a single IBBA managed portal. Credit rating agencies could provide better assessments. Institutional investors could model recovery risk better. Market analysts could forecast haircut trends across sectors. Such transparency would also increase bidder interest because data would not be hidden behind opaque RFRP barriers. So, to conclude, I think insolvency doesn't mean secrecy. The more transparent the process, the more disciplined the market. If we want capital markets to support stressed entities through refinancing, distressed investing, or ARC participation, we must ensure information flows are robust, timely, and credible. Okay, let's go to the next slide. Okay. So we have now seen the interplay of capital markets with insolvency law, the challenges, the gaps, and the impact on investors. But the real question is what's next? How can we make India's insolvency framework more market aligned, investor friendly, and globally respected? So let's explore actionable reforms that can enhance market resilience, restore investor trust, and make the IBC ecosystem more future ready. So the first and most critical reform is disclosure. So IBBI, SEBI, and NCLT must collaborate to frame clear disclosure protocols during CRP. Key documents like IM, claim summaries, COC voting outcomes, and resolution plan highlights should be made publicly accessible with redactions as needed. Debenture trustees should be held accountable for timely and proactive communication to bondholders. Think about how listed companies file disclosures with the SEBI. Why should insolvency, which affects thousands of investors, be an exception? So, better information is equal to better pricing is equal to better outcomes. Okay, another reform is empowering bondholders in the COC framework. So bondholders currently participate indirectly in CRP, often through debenture trustees, who may lack incentives or urgency. So new rules should mandate bondholder voting either through e-platforms or coordinated trustee action. Institutional bondholders like mutual funds, banks, and insurers should be encouraged to actively vote on plans. COC voting reports should clearly show how bondholder interests were considered. So in DHFL and Reliance Capital, bondholders accounted for a huge share of claims, yet they had a limited say. Empowering them enhances fairness and protects India's corporate bond market. So the next one is market linked resolution benchmarks. Uh, right now, resolution plan evaluation is often subjective. Values assign numbers, COC negotiates, and the highest haircut sometimes wins. We need market linked benchmarks. Use traded bond yields as indicators of value recovery. Allow distressed debt pricing data to inform plan fairness. Incorporate ESG, compliance, and governance scoring into plan evaluation. This would bring objective, investor aligned discipline to the resolution process. Another reform could be cross border insolvency framework activation. So, India must stop delaying the adoption of unsettled model Part Z draft. This law enables foreign creditors to participate meaningfully. It brings predictability to enforcement of foreign orders. It signals that India is serious about capital mobility and legal uncertainty. Sorry, legal certainty. Um, Without cross-border recognition, capital flight will continue. Part Z must be enacted with SOPs and institutional capacity building. Next reform could be institutional coordination task force. So too often, um, SEBI, RBI, and IBBI act in silos. A formal corporate capital market insolvency task force should be created. This body can publish joint circulars, timelines, disclosure norms, and investor protection standards. It can also interface with exchanges, rating agencies, and FPIs. Island Affairs, DHFL, and SREI showed us what happens when regulators don't coordinate. Investor panic, confusion, and value erosion. So, next reform could be promoting a robust distressed debt market. So, globally, distressed debt funds play a major role in reviving value. India should ease FPI access to distressed debt under ECB and bond regulations. ARC regulations should be streamlined to allow co investment with global funds. NCLT timelines must be enforced so that resolution remains time bound and attractive. A deep, liquid, distressed market increases recovery chances and reduces COC dependence on promoter only offers. Another reform could be insolvency tech and analytics. Digital innovation is a low hanging fruit. IBBA should launch an interactive dashboard showing resolution progress, plan values, and investor recoveries sector wise. Claim filings, valuations, and voting could move to a single digital platform. Tech enabled audits could track plan implementation and violations. Technology can democratize access to insolvency data and it can support investor due diligence. So, in conclusion, India's insolvency capital market interface is still evolving. We have made progress, but our approach remains reactive, responding to crises rather than designing robust frameworks. The way forward is clear: transparent disclosures, regulatory synergy, investor inclusion, global alignment, tech integration. These aren't cosmetic upgrades. They are essential to build a capital market ecosystem where insolvency is seen not as a failure but as fair reset. Uh, that's the future reforms that we can think of and expect it to come. Let's move to the next slide. Yeah, so these are the final thoughts. So basically, I thank everyone who has stayed engaged till now. So I think since this is a recorded format, you can use this opportunity to pause and reflect. What did you learn today? What is something that you did not expect to exist in the system? And what resonated with you with your current work or study that you're doing right now. So there are few questions that you may encounter in this particular topic or discussion which I have um, no no listed down, and let's just try to answer those questions. So one is, can bondholders vote in CARP? The answer is yes, but usually through debenture trustees. Their direct participation depends on claim filing, documentation, and COC composition. Is there a legal way for foreign creditors to enforce rights in Indian insolvency? Um, as of now, not easily. Recognition is ad hoc unless bilateral treaties or cross-border frameworks are adopted. So what happens if a mutual fund holds defaulted bonds? So the NAVs may be marked down. Um, Fund managers must follow SEBI guidelines for valuation and disclosures. Recovery happens only if resolution yields some payout. So I have few questions, for you to take it as a reflective exercise. I just want you to have give an answer as a reflective prompt rather than thinking and telling. If you were designing the ideal COC for a distressed company with 60% bonds and 40% bank loans, how would you structure investor voting? Would you let debenture trustees represent all bondholders? Give large bondholders direct seats? Use e-voting by ISIN wise identification. So I will repeat for the sake of clarity. If you were designing the ideal COC for a distressed company with, let's say, 60% bonds and 40% bank loans, so how will you structure this voting? Would you let debenture trustees represent all the bondholders? Or would you give large bondholders direct seats in COC? Or would you use e-voting by ISIN wise identification? So these kind of questions shows up in policy making. So these are not just theoretical questions. It affects real investors and outcomes. So these are the final thoughts on this topic, and I would also suggest few reading materials. You can go through Insolvency Law Committee report on the cross-border insolvency framework proposal, draft Z, part Z, which was also discussed in our previous session. And you can also refer SEBI discussion paper on strengthening trustee framework 2021. You can also refer RBI Prudential Framework for Resolution of Stressed Assets, June 2019 circular. Um, IBBI discussion paper on valuation and market linked resolution. Jet Airways and DHFL entlet orders. ILFS resolution strategy. government submissions and progress reports, unsettled model law guide with India specific adaptation notes. So yeah, I mean, just the closing thoughts are like capital markets and insolvency can no longer operate in silos. If we want deep, resilient financing ecosystems, investors need clarity and confidence even in default scenarios. From disclosure reforms to regulatory collaboration, from empowering bondholders to activating cross border protection, we have the roadmap. So, if you are a law student as a future lawyer, and if you are already practicing as an advisor or a finance professional, or if some of you would become policymakers, whatever we have discussed today will make you quickly and interpret, design, and influence the how the financial and legal system supposed to work. So that's all. That's all for this discussion. Thank you again. Um, until next time, stay curious and stay invested. Thank you.